Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. So in my macro updates, I take a look at various macroeconomic indicators to then try and establish how much my total portfolio I really want to be in stocks. At the beginning of 2020, I'd initially planned to invest in 10 stocks. Let's call that 100% in stocks. But then the corona crash happened. And so in the end, while I was trying to navigate what the hell was going on, I ended up only investing in two stocks. Now, there were a lot of people who were buying stocks earlier in the year and saying that the government's going to print loads of money to keep up stock prices while, whatever happens. But I'm actually quite pleased with myself that I didn't rush. I only bought two stocks and I allowed myself time to try and work out what was going on. We see that in April, the stock market rebounded as the government performed quite an extraordinary amount of quantitative easing. But then, actually, over the summer, really it's been lagging a bit. You could perhaps say sideways until John Biden won the US election, and there's a clear inflection point here where the FTSE 100 rose along with the S&P 500, of course, when Joe Biden won the election. So we can see that the GDP did stabilize following this massive bout of quantitative easing, and the FTSE did stabilize as well. But at this scale, it's not really clear if we are going to keep on going up to record highs along with government bailouts and money printing, or if in fact we could be on the way down. At this scale, it doesn't look too clear. So I've spent a lot of time trying to find the answer to my question, which was why I wasn't going in and buying more stocks this year. Why is it that despite the falls in GDP, the higher unemployment, and the ever increasing fiscal deficit, that the stock prices were going up? And I think I've got at least halfway towards answering that question. So what I'm going to do is I'm going to give you my executive summary first, and then I'll really dig into the detail afterwards. My executive summary is that modern monetary theory is now fully established as the main government playbook moving forward. This only works because of massive deflationary forces caused by globalization, the internet, and modern technology. And this leads them to think that they can keep on printing money as much as they like without having to raise interest rates to avoid inflation. And as long as inflation is low and house prices are stable, governments will keep printing money and keep on taking on massive debts to meet their aims, which are number one, safeguarding the GDP and jobs, and two, keeping the stock markets up. So my conclusion is that I'm happy to gradually build up a stock portfolio next year through careful stock picking, whilst monitoring key macro risks for a sea change. These key risks would be particularly currency inflation, but also price inflation and any clear damage to gross domestic product and house prices. So historically, you can see down here that inflation tended to be higher throughout the earlier parts of the last century. What the general rule book used to be, according to Keynesian economics, when there was a very strong economy and inflation started to go out of hand, they would raise interest rates in order to slow down the economy. And then when they went into hard times, they would lower interest rates to help boost the economy. And this was quite established for a long time until we had the financial crisis of 2008, 2009. And we can see here that interest rates were dropped from 5% to 0.5%. and the government began to embark upon a load of quantitative easing, which was just basically printing money and lending it to banks in order to prop up the GDP of the country and the FTSE 100. Actually, when I've been looking at all these different factors, one correlation that I can see is a slight correlation between GDP and the FTSE 100, which seems to have a larger amount of variance, but tracking the GDP. I couldn't really see any other correlations with the other things, apart from perhaps the quantitative easing. So yes, so they had a complete break from the past accepted doctrine, and in 2009 the government started printing a load of money, and this is quantitative easing, and lowered interest rates to 0.5%. Now, in the past, people would have expected there to be loads of inflation and then a massive disaster if you did this. But the government seemed to get away with it, and they look like heroes when over the last 10 years we saw the FTSE 100 reach record highs. The quantitative easing stayed around the same. Then we had the corona crisis, and of course, despite these terrible numbers of unemployment going up, to now 6.8%, GDP falling by 6%, then 20%. Those are really horrendous numbers. And despite the fiscal deficit going up really high, I mean, if you look here, this is normal fiscal deficit. This is what it's jumped up to during the corona crisis. And you can see here now how the government owes more than it produces in GDP every year. Government debt is now above 100% GDP. So these are really terrible numbers. But despite this, we had the stocks rebound back up, and the stock prices were fairly well protected, only dropping about 15 to 20% by this action by the government. So the question is, why is it that the governments don't have to worry about inflation going out of control when they lower interest rates to almost nothing? And having done lots of research over the year and listened to various sources of information over the year, the current almost mainstream theory is that what we have is the establishment of modern monetary theory as the economic model which allows governments to do this. Now, as I explained in the summary, modern monetary theory runs on the premise that currently, because of modern technology and globalization and the internet, there are actually large downward forces or large deflationary forces restraining inflation in the Western world. Plus, the stronger economies, particularly the US, they don't have to worry about currency inflation so much because they have reserve currencies. So what's happened really beginning with the financial crisis in around 2008 and then underlined with what they've done this year is this new system known as modern monetary theory, where as long as house prices are relatively stable and price inflation is low, governments can protect the stock market and hobble GDP by printing loads of money in terms of quantitative easing and going ahead with large money handout schemes. So this could be things like the furlough, where they were paying people to just sit at home doing nothing, all the various other money giveaways, protecting airlines and protecting the cruise liners. And this is now almost becoming established government policy within this modern monetary theory. So under modern monetary theory, governments can lower interest rates, employ quantitative easing, and also partake in huge government schemes like the furlough schemes or just bailing out the cruise liners and this kind of thing in order to protect the stock market and also keep GDP hobbled. And they no longer worry about things that they used to, like currency inflation, unemployment, and the existence of these fake and non-productive jobs, and having a fiscal deficit. Under this modern monetary theory, governments believe that they can continue putting their country into more debt. And we're talking about 2.1 trillion debt now in the UK. But governments are quite happy to do this because they believe that under this modern monetary theory doctrine, they can continue to get away with it. My kind of overall conclusions are that it's reasonable to believe that this modern monetary theory can work, and it can be okay to expect stocks to remain sideways or even go up a bit over the next year. However, at the same time, there's also a possibility that it could just all explode. So my plan is to go through in a careful way, and at the same time continue to track my macro to look for any clues that something could be going seriously wrong. The playbook is that as long as inflation remains low, we kind of don't really need to worry about anything else. One thing though is that there is a difference between general inflation and currency inflation, and I want to look at and I want to start developing tools of trying to assess, are we suffering from currency inflation? Because I think that currency inflation could be something that could be where the whole thing breaks down. I think that this is like a machine that's running at 1,000,000 RPM, but I think the currency inflation could be the cylinder that breaks and then the whole thing blows up. So yes, so my general policy is that I will then start buying stocks next year at a slow pace, whilst just keeping out for the whole thing exploding by tracking the macro factors generally, and then also trying to keep an eye particularly on currency inflation and general inflation. Okay, so now just to go through, explain the detail. So interest rates have remained at record lows, 0.1%, and the government, you can see, pumped in up to 900 billion in their quantitative easing program. Inflation has remained very low at 0.7% in October, and house prices have remained pretty stable this year. GDP, meanwhile, had a shocking reduction in the middle of the year. It went down 20.4% in June, but then it's just seemed to have recovered. And this is a bit of a stepwise drop down. Actually, when we look here, the GDP, it just stepwise dropped down, but that drop was, although pretty bad, at least it seems in control. So unemployment seemed fairly steady throughout the year, but now has stepped up to 6.8% in October, a little bit worrying. In terms of fiscal deficit, that's now at 100. So really, at the start of the year, we were looking at a fiscal deficit of 80%, and that's jumped up by a fifth to around 100%. So yeah, pretty nasty, but like I'm saying, it's an overheating engine, but the general consensus is it's not going to burst. We've still got like 3 to 5 years. So then looking out for currency inflation, and this is something I'm going to develop more in the future, but against the Swiss franc, the pound sterling was actually pretty stable this year, and against the Singapore dollar, it was also quite stable this year. So looking at the S&P 500, and this really was more of a V shape, and in contrast to the UK, which actually looks a lot more reasonable. Yes, the S&P is right back up at record highs again. We see again the clear inflection points here of the Corona crash, money printing, and then Joe Biden winning the election. So the US also have low interest rates, and they stepped up quantitative easing big time. Their inflation didn't drop as much as ours and is still fairly low at 1%. And their house prices actually went up slightly this year. I can't help but think that this year has been a transfer of wealth where poor people have got poorer, whereas the rich people who own stocks and houses have just got richer. Now, GDP was really alarming in the US. It went down by 31.4% in the second quarter. However, then it jumped up hard in the third quarter by 33%. And so in the US data, there is a fairly hard jump up in the GDP, which then is matched by the stocks. Unemployment in the US seems really high at around 7%. It was, of course, 11.1% in the middle of the summer. And its fiscal deficit is now much higher. It's gone up from 107% to 138% of GDP. So overall, the US situation mirrors the UK situation. And in conclusion, I'm actually glad that I was cautious, because I had no idea what was going on this year, other than the data looked really hideous. It looks like, to me, the general feeling is that the UK government and the US government really are completely living by the rule book of modern monetary theory. It seems that they're at the outer excesses of what they can get away with. That engine is really, it's shaking and it's really hot, and it kind of seems like it might explode at any time. But I kind of feel like the likelihood they're just doing as much as they think they can get away with. And once we get through the Corona problem, they will then, you'd expect, start paying off start doing some quantitative tightening and maybe raise interest rates to slow down things and get into a much safer gear, whilst the GDP starts to rise again. So the kind of most likely scenario, to my mind, is we'll see like a sideways, but it will be a very choppy sideways. And that's why I'm very happy to, at a low rate, buy stocks next year to slowly build up my stocks in as the overall part of my portfolio. But at the same time, I will be keeping an eye on the key macro numbers, and in particular keeping an eye on currency inflation, just to watch out for any signs that the whole house of cards goes crashing down. But it seems like, that could happen a year from now, or that could happen 10 to 20 years from now. So I do feel fairly safe buying one more stock this year, and then completing my stock purchases very slowly over the course of next year.